Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA CLASSROOM. Now let's start today's video tutorial. Today we will start share valuation model. The valuation model used to estimate the intrinsic value of a share is the present value model. The intrinsic value of a share is the present value of all future amounts to be received in respect of the ownership of the share computed at an appropriate discount rate. Previously, we have seen that multiple year holding period model. These are our multiple year holding period model. So in order to use this present value model for share valuation, the investor has to forecast the future dividends as well as selling price of the share at the end of his holding period. That means he has to forecast what will be his dividend or what will be the share price, selling share price at the end of his holding period. So sometimes actually it is not possible to forecast these variables accurately. Hence, this model is practically infeasible. Modification of this model have been developed to render it useful for practical purpose of a stock valuation. In the case of most equity shares, the dividend per share grows because of the growth in earnings of a company. In the other words, equity dividends grow and are not constant over time. The growth rate pattern of equity dividends have to be estimated. Different assumptions about the growth rate patterns can be made and incorporated into the valuation models. Two assumptions that are commonly used are. So, two assumptions that are commonly used for these valuation models, that is, dividend grows at a constant rate in future, or you can call it the constant growth rate model, and two, varying dividend grows at a varying rates in future, or multiple growth assumptions. So these are the two assumptions in this purpose, because multiple year holding period actually practically infeasible. To correction this method, there have two assumptions. One is dividend will grow at a constant rate in future, and another is dividend will grow at varying rate in future. That's why the multiple year holding period model can be divided by two assumptions, or here has in between two models. One is constant growth model, another is multiple growth model. So now we will see constant growth model. In this constant growth model, it is assumed that dividends will grow at the same rate into the near future, or indefinite future, or fixed future year. So we will see here has a new thing, that is G equal to growth rate. Growth rate, that means dividend will grow at a constant rate. Here discount rate K, discount rate should be the greater than G. Discount rate or required rate of return should be the greater than the dividend growth rate. This is G, means dividend growth rate. By the applying the growth rate G to the current dividend mark as a D naught, current dividend expected to be dividend after 1 year should be in this way. D1, dividend expected dividend after 1 year should be calculated in this way. D naught into 1 plus G power 1 after 1 year. D naught means current dividend. Current dividend. Expected dividend after 1 year, D1 equal to D naught into 1 plus G power 1. Expected dividend after 2 year, it should be D naught 1 plus G power 2. Expected dividend after 3 years, it should be D naught 1 plus G power 3. In this way, we can calculate the expected dividend for the indefinite year, not infinity, indefinite year. That means fixed several years. So that means it should be the Dn equal to D naught 1 plus G power n. That's why the present valuation model should be S naught divided by D1 divided by D1 divided by K minus G. So we can see, we will see our valuation model is S naught, that means present value of this constant growth rate model equal to D naught 1 plus G divided by K minus G, required rate of return minus growth rate. So it should be a formula for expected dividend 1 divided by K required rate of return divided by G. We can write down this formula in this way. And we know that this model is known as Gordon's share valuation model. Gordon's share valuation model. Share valuation model. This model is also known as Gordon's share valuation model. This constant growth model is known as Gordon's share valuation model, named after the model's organizer or creator, model's creator Myron J. Gordon. This is one of the most well-known and widely used models, dividend models. This is one of the most well-known and widely used models because of its simplicity. The model does not require forecast of future dividends and future selling price of the share. All that the model requires is a dividend growth rate assumption and a discount rate. Both of these can be estimated without much difficulty. That's why the growth rate may be estimated from past growth rates of the dividends and earnings. The discount rate is the investor's required rate of return, which is somewhat subjective and would depend upon the investor's alternative investment opportunities and his perception of risks involved in the purchasing of shares. Now here we will see an examples. Gordon's share valuation model. Let us consider an example. A company has decided a dividend 2.5 per share for current year. It decided that it provides dividend, current year dividend equal to 2.5 taka. So we will write down the problem. The company has been following a policy of enhancing its dividend by 10% every year, and it enhancing 10%, that means growth rate should be 10% each year for now. Is expected to continue this policy in future also. An investor who is considering the purchase of share of this company has a required rate of return is 15%. That means his required rate of return is 15%. These are our information from these examples. We will see the company decided that this current year, that means D naught, current year dividend will provide 2.5 taka and expected to grow 10% for the in future, and this investor's required rate of return is 15%. Then what would be its present price or intrinsic value of this share? Then if we use the Gordon's model, we will see the matters. So by the use of Gordon's model, we will see that our current dividend 2.5, 1 plus growth rate 10%, that means decimal point 10 divided by Our required rate of return is 15%, 0.15 minus 0.10. By the calculation, by the use of our calculator, the result should be 55 taka. So the investor would be advised to purchase the share if the current market price is lower than 55 taka. So it is clear that the investors should be advised to purchase this share if its market price is lower than 55 taka. This is our Gordon's share valuation model or constant growth model. This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.